The market is near record highs, but it feels like the same few stocks are doing all the heavy lifting. So how do you protect your portfolios if this rally starts to narrow or crack without missing upside? Wayne Penello is the CEO of NextGen EMP and joins us now. Wayne, great to have you on.
I'm thrilled to be here. Pleasure to meet you, Carolyn.
So we'll get into that. But first, as we think about portfolio protection, do you think this market is more fragile than the indexes at all-time highs suggest?
I think the market and the overall economy is very strong here, but you have to be prepared, um, both mentally and ideally prepare your portfolio for the kinds of drawdowns that sometimes force people to make bad decisions and push them out of the market just when they should be staying in the market.
So we'll talk about how to protect your portfolio. But before we do that, I do want to ask you about concentration risk in this market as well, because the same 10 companies now make up roughly 40% of the S&P 500. Are investors too concentrated in the same tech and AI names right now?
Well, if you want the outsized returns everybody's getting, then you're going to have to invest in those few companies. So yes, you have concentration risk, and if you're willing to settle for 5 or 6% on your a return on your money, then diversify and you don't have to worry about it. But if you want the 10 to 12% or higher returns that the broader market is giving you, then you're going to have that concentration exposure. You're going to be subject to some significant drawdowns. I mean, just in this first half of the year, the S&P has already had 10% pullback. So the goal is to have a diversified portfolio, but recognize that in times of crisis, correlations jump to one. So you've got to find a way to manage the risk in your portfolio so that you've got the staying power through some of these, hopefully short term, but nonetheless sometimes painful drawdowns.
What's the smartest way, though, to reduce risk or manage risk without completely missing upside?
If you want to participate in these higher than normal returns, then you have to take an overweighted exposure into semiconductors and artificial intelligence. I mean, one of the things that people aren't aware of is in 2001, when Enron was dropped out of the S&P 500, a little known company at the time that they added was NVIDIA. And NVIDIA since then is up 47,000%, which means that in 2001, if you put $1,000 into NVIDIA, you'd have 470,000 today. So you want to own these companies, but you have to do it in a way where when they have, which NVIDIA has had, a 50% pullback, you're not chased out of it. And that more importantly, that you can use that pullback as a way to add to your position with the confidence that you have the financial resources to weather the storm. So right sizing the position is very important. You know, portfolio selection, it's nice if you get them all right, but you're not going to get them all right because nobody gets them all right. So you're going to have to pick a bunch of what you believe are winners. Try to find some companies that you think are going to underperform. Don't include them in your portfolio, and more importantly, consider holding them as short positions in your portfolio to counterbalance the beta risk of the market. And that's hard for the individual investor to do because if you're only going to look at your portfolio once a month, then probably not a good idea to start trading like an institutional investor, and you might want to look for advice on let somebody do that for you.
Okay, so that's where the Efficient Market Portfolio Plus ETF, EMPB, comes in, your fund. It's a long short fund. Tell us, how does it actually play offense and defense at the same time?
So our program is driven by an algorithm that statistically tries to determine, who's in control of the market, and when that means who's putting money into the market and who isn't. And so we use the algorithm to identify which industry sectors we think are likely to meet or outperform the average over the foreseeable future. That doesn't mean that we think the market's going up or down. It just means that we think that this is a stronger industry than the other industries. So, our longs this month would include the triple Qs, semiconductors, MSH, solar, TAN. These are very volatile in and of themselves, and they can have huge 20, 25% swings. So you can't overload that portfolio with just those and not be cognizant of the risk. And so we then balance all of this with short positions, which right now our short positions include, discretionary consumption, retail, utilities, home construction for one.
Help us think about downside opportunities a bit more with shorting, because that might be intimidating to some investors. Why is shorting misunderstood, and why should investors potentially include shorts in their portfolio?
So the state of the art is that if you short something, it can go to an ungodly number, infinity. And so you could lose more than everything that you have invested. Whereas if you own something, it can only go to zero. So that's the, if you will, the brackets that people lean on. But it really doesn't make much sense. And so what we do in our fund is we are 100% long equities. Based on, and we're a fund of funds. We're long, not just individual stocks, but we're long industry sectors of stocks. So we've got fund managers who manage billions of dollars. They're some of the best on Wall Street, making decisions about within that industry which stocks they want to own and which they don't. And what's nice about this is that within any given sector, there are multiple competing fund managers, and so we evaluate them and try to pick the best of the best, if you will.
When you look across the market today, what areas actually look underappreciated to you? Because you mentioned the Qs, you mentioned semiconductors. Those are sort of the obvious bets, right? At this point, are there any areas that are overlooked?
I wouldn't phrase it that way. I think there are areas that are going to underperform because they need time for the efficiencies that AI is bringing to the marketplace, and
Hmm.
the companies that are going to grow in support of that industry, and those new efficiencies that we're getting. So, there, like healthcare is unlikely to be a champion in the next couple of years, right? It's if we have another COVID event, that's all completely different. But in the real world, healthcare is a low margin business. So it's something you might include in your portfolio to stabilize your portfolio. But then again, in a high risk environment, which some would argue we're in now, you might actually use healthcare as a hedge, so that you sell a little bit of it.
So, Wayne, explain to me why I want to hold your fund versus just being invested in the S&P 500.
This goes well beyond just our fund. It's ETFs are the best deal that investors have available to them. Because if you were to go to any ETF, they're all required to report their positions daily. And you were to mimic that. Anytime you rebalance that portfolio, that triggers a taxable event to you. But in an exchange traded fund, we have 531 exchanges, which means that I can rebalance the portfolio without triggering a tax event. And so that is to me, that's a windfall, because it, it just helps you defer taxes and convert them from short-term gains to long-term gains, which is definitely in every investor's interest.
So, just finally, to sum things up, and just quickly, what's one portfolio adjustment retail investors should consider today to protect their portfolios?
If you can, make a good estimate of how much risk you have in your portfolio, and if you don't have the math skills to do that, just assume that you, at any point in time, my portfolio could be down 25% from where it is now. Can you live with that number? If you can't live with that number, immediately diversify enough away into bonds, treasuries, so that when you are down 25%, you're not shaken out of the position, and you don't have a loss that's going to materially change your life. I think you're going to be in pretty good shape, because to me, I'm very bullish on the American economy. I think that the revolution we're about to go through here is bigger than electricity. I mean, the 1929 bubble burst, and nobody ever asked themselves what caused the bubble. Everybody thought that these efficiencies were going to be the greatest thing since sliced steaks, except that we didn't have enough market for all of this new productivity, and that's what caused the bubble burst. Well, AI, we're in the early stages of AI, and the productivity that I see is going to dwarf anything that we have lived through in our lifetime, and will probably exceed the benefits that we got from electrifying the whole United States. And I have very confidence in that, because when you ask anybody about AI, I don't care if they're 20 or 80, they're all looking at it, they're all using it in their own ways. But the warning sign is
Mhm.
going to be when they start telling you which AI companies to own. When they start telling you which AI companies to own, we've probably peaked, but we're not there yet. So I think there's a lot of upside in this market, and people should find a way to own equities to their comfort level.
Okay, we'll leave it there. Wayne Penello, CEO of NextGen EMP. Thank you so much. Really appreciate it.
Thank you very much for having me.
If you enjoyed this ETF Spotlight, check out our full interview with SoFi's Brian Walsh, where he breaks down why so many investors are using ETFs wrong and where active ETFs actually make sense.